Alright everyone, let's start with the question on provision for doubtful debt. The question came in June 23, paper 21, question number 2. And the syllabus code is 7707, that is O-level accounting exam. Stella is a sole trader who sells on credit. She maintains a provision for doubtful debt at 4% of trade receivables. Okay. Stella's trade receivables at 31st December 2021, $75,000. At 2022, that is $77,000. Let's read the requirement first. Prepare Stella's provision for doubtful debt account for the year ended 31st December 2022. Balance the account at 31st December 2022 and bring down the balance on 1st January 2023. Alright, so let's begin with the requirement. You only need to make a ledger of 2022. So in 2022, we need a balance brought down, which is not given over here. We need to find out by finding provision for depreciation of the last year. So in 2021, trade receivables were $75,000. Into 4% provision percentage is given in the question. You will get $300,000. So that was the provision for doubtful debt for the last year. That is your balance brought down for this year, 2022. The balance brought down figure would be $3,000. In 2022, $77,000 into 4%, you will get $3,080. So now you need to compare this figure with the last year's provision, and it says 3080, it is increased by $80. I've also explained it in the lecture. Whenever provision for doubtful debt increases, it's an expense for the business. So on the credit side of provision for doubtful debt account, on December 31st, income statement charge would be $80, the difference of the amount. And if, let's suppose, it is decreased, the income statement will be charged on the debit side of the account. So we have solved it. $80 will be charged on the credit side. The provision for doubtful debt is increased. Let's balance this account. The total of the credit side is $3,080. Debit side should be $3,080. The entire amount would become balance CD, that is $3,080. And now the requirement will be completed when you show the balance brought down for the next year. So in 2023, on January 1st, the balance brought down would be $3,080. I hope the concept is clear. We have solved it. We have made a provision for doubtful debt account for 3 marks. Next is theoretical part of the question. The question says, state 2 reasons why Stella maintains a provision for doubtful debt. The reasons to charge provision for doubtful debt in the books. Number 1, to record future trade receivables that may not pay the amount or the balance owed. First reason. Second reason, to apply concept of matching, that is an accounting concept, matching concept, to ensure that the sales for which payment is unlikely to be received. So for 2 marks, you can memorize this theoretical part. Why do we charge provision for doubtful debt in the books? So this is the very first question that we have solved on provision for doubtful debt, which came in June 23, paper 21. We shall also solve a couple of questions more in order to have a clear understanding of this particular topic. I hope the question is clear to all of you. Alright everyone, let's start with another question on provision for doubtful debts that came in November 22, paper 23, question number 5. And syllabus code is again 7707, that is O-level accounting exam. NT started in business on 1st September 2020. All sales are on credit and payment is required for customer within 25 days. So there is a 25 days cushion period for payment to be received by trade receivables. On 5th May 2021, LW, a trade receivables, was declared bankrupt and a debt of 600 was written off as irrecoverable at that date. Prepare a journal entry to write off the amount owed by LW. A narrative is required. Okay. So let's make a journal entry. 2021 May 5th. That is an irrecoverable debt and it is an expense. It will be recorded on the debit side. Irrecoverable debt will be debited. That is $600 and LW will be credited by $600. And a narrative that needs to be recorded like this: to record bad debt of LW. Now you will get 3 marks over here. Next up, in addition to the irrecoverable debt of LW, other irrecoverable debts of $4,100 were written off during the year ended 31st August 2021. Trade receivables at 31st August 2021 were $91,500 and NT decided to create a provision for doubtful debt at 5% of trade receivables. So, trade receivables at 31st August 2021 were $91,500. It means that is a closing balance of trade receivables that is given in the question. Assuming, we have to assume over here that return or bad debts are already being written off from this particular amount. So you do not need to deduct bad debts from this amount. Again, it is already being deducted, and $91,500 was the closing balance of trade receivables at year end 31st August 2021. So you just need to find provision for doubtful debt for this year, that is 2021. Trade receivables are 91,500 into 5% was provision, and the answer would be 4,575. So it's an easy working. Trade receivables multiplied by provision percentage, you will get the amount, that is $4,575. So requirement is prepare an extract from expense section of NT's income statement for the year ended 31st August 2021. We just need to show the expense area of income statement that is asked in this particular question. So I am writing down expenses. First expense were recoverable debts, that is $600 plus $4,100. LW plus others, you will get $4,700 over here. And another one is increase in provision for doubtful debt. You can also show working in the bracket. 91,500 multiplied by 5%, you will get $4,575. This is an extract of income statement expense section. Why I've assumed it's an expense? It's an increase because there was no provision for doubtful debt charge in the previous year. It is assumed to be 0 last year, so the entire amount will be treated as an increase in provision for doubtful debt. And whenever the provision for doubtful debt increases, it's an expense for the business. I hope it's clear to all of you. Let's move on to the another part of the question. Prepare an extract from the asset section of NT's statement of financial position at 31st August 2021. So over here you need to show the extract of current assets, which I have also explained it in the lecture video. Write the heading of current assets over here. Write trade receivables. That was $91,500. I am not writing again irrecoverable debts because it's already been deducted from the figure. It's given after written off. Next one is provision for doubtful debts. That is $4,575. And the final figure of trade receivables would be $8,692.5. This is the extract of current assets and how to show trade receivables. The total of provision for doubtful debt will be deducted from trade receivables amount. Bad debts will not be deducted because it's already been written off. Let's continue with the further part of the question. During the financial year ended 31st August 2022, this is the second year. PB, a trade pay receivable who owed $7,000, had been declared bankrupt. Okay, so PB has become irrecoverable debt. On 17 July 2022, NT received payment $2,500 by check in final settlement of the debt. So, out of this $7,000, business has received $2,500 by check, and the remainder amount will become irrecoverable debt. Okay, how much is the remainder amount? That is $7,000 minus $2,500. The bad debt amount would be $4,500. Other irrecoverable debts of $8,400 were written off at 31st August 2022. The remaining trade receivables at 31st August were $110,000. Remaining trade receivables means at 31st August, it's again a closing balance of trade receivables. Bad debts are already written off from the actual amount. So over here, an NT decided to maintain the provision for doubtful debt at same 5% as same as the last year. So over here, if I charge provision for doubtful debt, it would be 110,000 multiplied by 5%. You are going to get $5,500. I hope it's clear. The working is clear to all of you. So over here, now again we have to compare the provision from the last year. In 2021 August, provision was $4,575, and in August 2022 it is increased to $5,500. So if I compare this provision for doubtful debt, it is again increased by $925. 5,500 minus 4,575, you will get $925. So again over here the provision has increased. Since last year it's an expense, will be recorded on the credit side of provision for doubtful debt account. So working is done. The next part is prepare the following ledger accounts for the year ended 31st August 2022. Bring down the balance on 1st September where appropriate. So first of all, we have to draw account of PV in the books of NT ledger. PV is trade receivable. How much balance was owed by PV? That is $7,000. It's a balance brought down. So in 2021 September 1st, balance BD on PB account must be $7,000. In July 2022, it has gone bankrupt and $2,500 was received. So in 2022, July 17, the check, the bank amount received was $2,500, and the remainder amount was irrecoverable debt, that was $4,500. Both the sides are balanced now. PB account is now completed in the books of entities ledger. So repeating again, the balance brought down figure was $7,000. So $2,500 was received by bank. The trade receivable account will be credited, and remainder was irrecoverable debt, that is $4,500. We have already found it in the working above. Next up is irrecoverable debt account, bad debt account. In 2022, first bad debt was occurred in July 17, that was PB, with the amount of $4,500, and other recoverable debts were $8,400, that was disclosed on 31st August 2022. So on August 31st, other bad debts were $8,400. First was PV, another one was others, trade receivables who's gone bad debts during the year. Now the balancing part of this particular ledger, the total of the credits debit side is 12900. Credit side should be 12900 as well. The entire amount on August 31st would be charged in income statement as an expense. So the total of $12,900 will be write off against income statement. There would be no balance carried down, no balance brought down in the account of bad debts. I've also explained it in the lecture. You have to write it off against income statement. Now, provision for doubtful debt. In 2021, September 1st, the balance brought down on provision for doubtful debt account must be the balance carried down of the last year, which we had solved previously. What was the provision for doubtful debt for the last year? That is $4,575. That is your balance brought down for 2022. So on September 1st, 2021, the balance brought down should be $4,575. And in this year, the provision for doubtful debt is increased by $925. It will be recorded on the credit side of the account. So I will change the year over here, 2022. August 31st, income statement amount would be $925. Now the account is completed. The total of the credit side is $5,500. Debit side should be $5,500. The closing date was August 31st, 2022. The entire amount will be charged against balance carried down, that is $5,500. In 2022, September 1st, we are going to show the balance brought down of $5,500. After solving these three ledgers of PB account, irrecoverable debt account, and provision for doubtful debt account, you will get 8 marks. So I hope the concept is clear to all of you, how to draw different ledgers: the receivable ledger, the bad debt ledger, irrecoverable account ledger, and the provision for doubtful debt account ledger. This is a very good question in which all the ledgers are tested. Concept of bad debt is tested, and extract of income statement and statement of financial position is also being tested by the examiner. Next part is theory 1. It's an easy one. Let's also discuss this part as well. Andy is concerned at the increase in irrecoverable debts during the second year of business. Okay. To reduce irrecoverable debts, he is planning to introduce one of the two following options. Option 1, to charge interest on all debts not paid within his standard term of payment of 25 days. Okay. Whoever exceeds this limit of 25 days, you are going to charge interest on overdue accounts. Option number 2, to stop supplies to all customers who do not pay within his standard terms of payment of 25 days. If people are unable to pay you within 25 days, you are going to stop credit sales to all those individuals. Advise NT on which option he should introduce, justify your answer. In this particular type of question, you need to assess both the options. Option 1, advantage, disadvantage. Option 2, advantage, disadvantage. And you can recommend any one of it to get an additional mark out of 5. So if I discuss option number 1 over here, customers, if you charge interest on customers, they might go to competitors. They might not do credit sales from the business. It will damage the reputation of the business. It will damage the relationship with the existing customers. Business is going to lose the customers as well, which results in the fall of sales and hence fall of profits. And administration costs would be increased, and the advantage would be that receivers will be encouraged to pay you early, and you can also offer them discounts along with the interest if they are going to pay you in early days before 25 days. Okay. And option number 2, if you assess is stop supplying. If you stop supplying them on credit, the overdue balance may never be paid. If there is existing balance of overdue accounts by trade receivers, they might not pay you back. It might go into irrecoverable debts. Another one, relationship with the customers again will get damaged over here. Customers again will go to competitors. So you are just assessing these two options for the exam, and you can recommend any of the option 1 or option 2, it's your own. So 2 marks will be given to assess option 1, 2 marks will be given to assess option 2, and 1 mark for your recommendation. So theoretical part is also very important in this chapter. In all the chapters of accounting, accounting is not only the calculation, it's also the theory as well. So you need to be very much concise in delivering your answer for theoretical purposes as well. I hope you have got the question. The concept is clear. You need to know how to draw a bad debt account, a provision for doubtful debt account. Alright everyone, let's begin with a new question that came in November 22, paper 22, question number 4, syllabus code is 7707, that is O-level accounting exam paper. Question says, PG, a trader, sells electric components. She has provided the following information for the year ended 31st July 2022. Sales journal means credit sales. Sales returns journal, trade receivable balance on 1st August, that is balance brought down. Provision for doubtful debt balance on 1st August 2021, that is again balance brought down. Cash book extract is also given for the year ended 31st July 2022. Discount allowed column, cash received column, bank column, and on the credit side they have given you trade receivable balance, dishonored check of $4,000. Additional information says $900 of trade receivables were written off as irrecoverable debts on 31st August. There were no other irrecoverable debts during the year. The provision for doubtful debt is to be set as 4% of trade receivables at 31st July 2022. So, prepare the following ledger accounts for the year ended 31st July, where appropriate show the balance brought down on 1st August 2022. Let's begin with the sales account. The sales figure for the year was $360,000. That is the total credit sales for the entire year. So in the sales account, you will charge 2022 July 31st, you will write trade receivables, and 360,000 will be credited. Sales are always recorded on the credit side. So in the credit side, $360,000 will be recorded by name of trade receivables. How much cash you have received from your receivables? That was $17,000. That is cash received. So that is cash sales. It means cash debit, sales credit. So over here on July 31st, you are going to record cash $17,000. These are the sales which is done on cash. So we need to balance the account now. The credit side total is now $377,000. The debit should be the same, $377,000. You are going to write off this entire amount on July 31st in income statement. That is 377,000. So over here there would be no balance carried down, no balance brought down. It is a total sales figure of the year which has to be charged in income statement. When you start to make income statement and start, that is the revenue, total revenue of the year. That is $377,000. Total revenue of the year. I hope the account is clear, the ledger is clear to all of you. Next part is sale returns account. the sale return balance was given 13,300 at the end of the year. That is the total sale return of the entire year. So journal entry would be sale returns debited, trade receivables credited. In the sale returns account, you will record 2022 July 31st trade receivables with the amount of $13,300. That is the total sale returns which will be recorded in your sale returns account. The journal entry would be sale returns debit 13,300 and trade receivables will be credited by $13,300. I hope this transaction is also clear to all of you. So now we have to close this account in July 2022. The total of the debit side is 13,300 will be credited with the same amount 13,300 and the entire amount will be charged against income statement for this financial year. So when you draw income statement, when you make income statement from the sales figure of $377,000, you are going to deduct sales return with the amount of $13,300. I hope this ledger account is also clear to all of you. Now we have to make trade receivable account, just like SLCA, sales ledger control account. The balance brought down would be on the debit side. That must be in 2021 August 1st. The balance brought down which was given in the question, that is $28,500. That is your balance brought down of trade receivable at the start of the year. So I will record $28,500 as balance brought down on debit side. It's an asset account. Balance BD would always be on the debit side. Now we have to record other transactions for the year ended 2022. First of all, we can record July 31st, the sales figure. Sales were $360,000. Let me make it very clear to all of you. There is a trade receivable account. Only credit sales will be recorded here, not cash sales, because cash sales are already being debited to the cash flow. So over here, where you are making a trade receivable account, you only need to record credit sales. I've also explained it in control accounts lecture in my previous videos. On the credit side, July 31st, you are going to record sales returns, which were also given in the question, that is $13,300. And now we have to see the other entries to record bad debt expense and all the cash received from receivables. We have to go back to the question. First of all, there were bad debts of $900. Irrecoverable debts will be recorded on the credit side. July 31st. Irrecoverable debts $900. Next up is how much cash has been received from trade receivables. So trade receivables cash received was $33,500, that is $335,100, and with the discount of $6,500, that is discount allowed. Both of them will be recorded on the credit side of trade receivables account. Discount allowed $6,500 and cash. Is it written in the cash column and the bank column? Sorry, my bad. It's received by check. So you are going to write bank over here with a figure of 335,100. I hope it's clear. The journal would be discount allowed debit, bank debit, trade receivables credit. So in trade receivable account, both of these figures should be recorded on the credit side if you follow journal entry. Next one is provision for doubtful debt will never be recorded in trade receivable account. It will be charged in separate provision for doubtful debt account. I've also explained it in control account lecture. There is one more entry over here, that is dishonored check. You must have received some check of $4,000 and it is returned back from the bank due to any reason. Either the check was not drawn correctly, either the balance was insufficient in the trade receivable account. So dishonored check will be debited in your receivable account. July 31st, dishonored check will be debited in our trade receivable account, that is $4,000. So trade receivable account is done. You need to balance it off. The total of the debit side is greater than the total of the credit side. I am using a different color over here. That is, the total of the debit side is 392,500. 392,500. If you deduct all other amounts from this figure, you will get the balance carried down figure, that is 36700. And this balance CD should be shown as balance BD for the next term. So next term would be September 1st. Balance brought down would be 36700. This is how we are making, we make trade receivable account is same as sales ledger control account. I hope this account is also clear to all of you. Next up is irrecoverable debt. How much irrecoverable debt was there in the year? That is $900. So in the debit side of irrecoverable debt account, 2022 August 31st, sorry, July 31st, trade receivables we have turned bad debt were $900. You need to balance this account. Total of debit side should be equals to the total of credit side. I have explained it previously as well. The entire amount of bad debt will be charged in income statement by $900. There would be no balance CD, no balance PD in bad debt account, in irrecoverable debt account. I hope it's also clear to all of you. Next up is provision for doubtful debt account. There was balance BD given in the question. That must be in 2021 August 1st. Balance brought down was given. The balance brought down figure would be on the credit side always. It's a provision account, and the balance brought down was given by $1140. So on the credit side, I am writing $1140 as balance PD. So now we are going to charge provision for doubtful debts at 4% per annum on trade receivables. Now you have already found balance CD amount of trade receivables in the ledger number 3, that is 36,700. That is your closing receivables. You are going to charge provision at this particular amount. So you need to be very much clear, and you need to be very much corrected in your exam to find the correct balance CD, otherwise your provision would be incorrect. Provision for doubtful debt would be incorrect. So I will use it as a working over here. Provision for doubtful debt 36,700 multiply by 4%, you will get $1,468. So again I am repeating myself, you have to compare this figure with the last year figure, which is already given in the question. That was 1140. If you compare this figure from your current figure, you can clearly say it is increased by $328. So again I am repeating it, that whenever provision for doubtful debt increases, it will be recorded on the credit side. So in this year, when you close your accounts on July 31st, income statement amount would be $328. Now balance the account of the credit side. Total is $1,468, double line, $1,468, double line. Entire amount on July 31st will be charged as balance carried down. So balance carried down figure would be $1,468. August 1st, you need to show balance brought down as well, that is $1,468. These 4 particular ledgers are giving you 13 marks for exam, and it's very much simple. You just need to follow the formats, you just need to follow the concept, general entries and provision percentage, compare it with the last year to find either it's increased or it is increased. Next part of the question says, prepare a relevant extract from PG's statement of financial position at 31st July 2022. Extract means only the relevant part, relevant element of SOFP that is being asked, that is current assets. You can make a heading of current assets over here. Write trade receivables. The balance of trade receivables was $36,700, in which irrecovered debts are already been deducted. You do not need to show it again over here, and you just need to deduct provision for doubtful debt from this amount, that is, and over here you need to take the total figure of provision for doubtful debt, not the difference. Difference is only for the income statement amount. So the total of provision for this year was $1468. $1468 will be deducted from this amount. You will get a figure of $35,232. That is it. That is your statement of financial position extract. Next up is list 3 ways in which PG could reduce the possibility of irrecoverable debts. Okay, so they can set credit limit, number 1. Number 2, they can charge interest on overdue accounts, and lastly they can take legal actions. There are plenty of points more. You can either write sell less on credit. You can either write notify your trade receivables promptly. You can either write improve your credit control, ask credit controllers to make reminders again and again. You can also write refusal to supply any further stock on credit until the previous amount has been cleared. So there are different ways you can write in an exam. It's more of a common sense part of the question. Say 2 factors PG should consider when setting the provision for doubtful debt. What are the factors? Past experience of the business. If there were any irrecoverable debts previously occurred in the past, so you need to charge provision for upcoming years. Number 2, second factor could be length of time receivable is taken to clear his or her debt. If many of the receivables are delaying the payment, are delaying the amount owed, so you can charge provision for doubtful debt in order to avoid any risk associated with irrecoverable debts in the future. So I hope we have solved 3 different questions of this topic, and I hope the lecture is clear to all of you. It is highly tested in exams, an easy concept. You just need to practice the lectures, and I hope it will help you to solve other questions whichever came in the previous exam papers as well. So if you like this video, kindly like it, share it with your friends, and do press the ring bell icon for upcoming videos. Thank you so much.